Hello, Mandy.
Good
Glad to,
morning.
good morning. Excited to have you both here. Before we wait for more people to trickle in, I like to start off with an icebreaker question. So, Mandy, we'll start off with you. Do you have any fun vacation plans coming up?
Well, yes, we just booked a trip for right after Christmas for 2 weeks. My family's going to Southeast Asia. So super excited about that to get out and do some big traveling after the last couple of years.
That's so exciting. And Lucy, do you have any plans coming up?
Always vague plans and never concrete. At the moment, trying to figure out where in the world would be good to live for a year.
Oh,
So
awesome.
some fun Googlings going on, but no concrete plans.
Somewhere warm. I would like somewhere warm. I'm looking at Costa Rica. I hear really good things about Costa Rica. But that's so great to hear that both of you have plans coming up. I know that travel is back on a lot of people's plans this year, so super excited for that. Now, I guess we can get started. I'm sure everyone is super excited to dive into the content. So, I just want to start off with some housekeeping rules. If you are familiar with MSP, you know you'll be able to access this event recording and key takeaways on the previous events page on the MSP website. Second, if you have questions for our speaker today, please use the Q&A function to ask any questions throughout the event. And for those who are not familiar with Modern Sales Pros, it is the largest and highest quality community for those in sales management, sales leadership, sales revenue operation, and sales enablement, aka our Modern Sales Pros. Our mission is to create an environment for our members to answer questions they struggle with to solve on their own and help them see around corners they might not know about. And we do that through live sessions like the one that you're at today, an online forum, our quarterly summits, and we're also starting to get back into in-person events. So if you're not already a part of MSP, you'll be invited to join after the event. And we partnered up with Sales Impact Academy today, who made this event possible. And as a member of MSP community, we want to ensure you get access to the best sales education, and partnering with Sales Impact Academy provides just that. I'll hand it off to Lucy to say a few words about Sales Impact Academy and then introduce Mandy, our speaker today.
Yeah, cheers, Angelica. So I'm on the partnerships team here at Sales Impact Academy. We are a live learning platform that are built for go-to-market teams like mine and like yours. And it's a place where leaders in the industry like Mandy Cole, who you're going to hear from, like Mark Roberge, Chris Voss, they share their earned secrets through live courses. So it's a live structured education from everyone from SDR to CRO, and I'm sure you'll agree it's sorely needed. We're partnering with Modern Sales Pros because this is where revenue leaders like yourselves come to learn, and we want to be there and part of that conversation. And this is what this event is all about. So I'll present our main event, Mandy Cole. She is a coach at Sales Impact Academy. I think you literally just finished a class, right, Mandy? The definitive, within a course called The Definitive Guide to Revenue Leadership.
Yeah, we kicked off today.
Just today. So fresh from that. But she's also a partner at Stage 2 Capital, which is a seed Series A VC firm that focuses on providing go-to-market expertise and support. They're backers of SIA, of Sales Impact Academy. Very grateful for that. And also to be here today. She's going to draw on her expertise as a demonstrably effective revenue leader. As some examples, she's led thousands of sales professionals, hired and mentored hundreds of sales leaders, and built and scaled some of the largest, fastest growing sales organizations over the last decade. So we are in safe hands. Taking two examples, Living Social, she took from 10 million to 750 million. And at Zenefits, built the largest SDR team in North America. So, Mandy, we are eager to learn from you today, and the floor is now yours.
Thank you, Lucy. I'm excited to be here, and really excited to hit up a subject that I think unnecessarily worries a lot of you, which is unit economics. One of my partners at Stage 2 that we just mentioned, Mark Roberge, just wrote a blog about how we see way too many startups and scale-ups using revenue as their North Star, when of course it's a lagging indicator that tells us what happened the last 12 months. And what we really need to know is what's going to happen the next 12 months and how can we orchestrate a plan to do that. So today we're going to walk through what are unit economics when you hear those, and how are they constructed? But then we're going to back into, okay, how can you build a plan so you know you're going to get the right unit economics? And then how do you make sure that you're measuring once you've got that plan and you're staying ahead of the game? So let's kick that off. Along the way, if you guys have questions, please feel free to throw them in a chat. I'm more than happy to answer, so that this doesn't become something that is a one-stop shop. So the challenge that companies have when they're scaling is to focus, again, we're focused a lot on that top line, right? Bringing in new revenue, but a lot of times we're not paying attention to the real economics of the business. And the reason that's important is it's going to determine if you can raise another round, and if you can do that at a valuation that you want. And frankly, with a lot of you that are in a situation where you have equity, how much your equity is worth. So as sales leaders and revenue leaders, we need to understand what unit economics mean and not just be focused on revenue growth. So I'm curious, actually, it really helps me if you guys want to throw in the poll or in the Q&A what stage your company is right now. Are you a seed stage, a Series A, a Series B, a Series C? Just so I get an idea of where you are, and I can think about tailoring that as we go through the plan. So if you've got that, throw it in. Sorry, I'm still getting used to turning the next slide. Okay. So let's talk about, it's the first time I use Goalcast. So sorry, trying to get back to the previous slide. Okay. So to me, unit economics can be summed up really as a high level check of your business. Frankly, how much is it costing you to sign up a customer? And then of the customers that you're signing up, are you retaining them, and are they growing with you? And then what is one customer worth? And sometimes that takes longer to figure out, but let's dive into what these mean and how you can calculate them. So we're going to start with first, what does it cost to sign up a customer, which is referred to as cost of acquisition, or CAC. The reason this is important is because it's a fundamental metric to measure not only in aggregate, but also for each market or segment territory. So if you've got a mid-market and you've got an enterprise, you want to think of those separate. But knowing that, and then we're going to talk about how that relates to long-term value, allows you to assess what segments are most efficient and profitable, or if your core business is efficient and profitable. So CAC is the cost that a business acquires, or the cost it takes you to acquire a new customer. So this includes all your fully loaded costs on this with sales and marketing, and it includes, salaries, and all your technology, anything that you're using to get those customers is what you would want to put in that cost. The reason that this is important is because it's one of the things that we look at, especially if we don't really know long-term value yet, if you're still just a couple of years in, or you're still, getting growing. So this is one way where we can evaluate the scalability and profitability of a business by looking at how long it takes to recover the money that you spent to get that customer, which is known as the payback period. And you can see here, I've got some benchmark standards that you would feel like are good for having that payback. So let's look at an example, because I think that will help everyone. Let's see. Okay, hopefully my next slide is going to happen. Okay, so I'm going to show you an example. And in this company, all their sales, they're all in sales and marketing costs, which include, again, the people expense, the technology, the marketing costs, are $25,000 in this quarter. And they signed up 20 new customers. So that gives them a cost of acquisition of $1,250 per customer. So to apply the benchmarking, you have to divide $1,250 by the average monthly revenue you're getting for that customer. So if the average monthly revenue for this customer is $250, then your payback period is 5 months, which is great, right? You should probably start investing more because you're doing a great job, being efficient at acquiring customers and getting that payback. But if your MRR is only $50 a month, then your payback period is going to be 25 months. And that's not that great because you have to wait 25 months to even start making any money on those customers, which is more risky. And if you guys have questions, and we've got a Series B in here, thanks, Comrade, on any of this as we're going through, feel free to throw it in the slide. So that's the first one, is you want to think about your cost of acquisition and how long it takes you to pay that back. The second is, which we feel like is a big North Star, right, is being able to retain and expand those customers, which typically is net revenue retention, or sometimes people do net dollar retention rate. It's the percentage of recurring revenue that you retain from existing customers in a defined time period. So what you do is you take, if you're doing it like for Q1, you would take, okay, this is where we started Q1, this is all the revenue we added with new and expansion sales. This is anything we lost from downgrades and cancels, and here's where we ended. And you obviously want that ending to still be above where you started, because then that means that your net revenue retention is above 100%, which is great. The reason this is so important to us as an investor is because this is what really shows you a product market fit. There's a need for your product. People are not only buying it, but they're staying and potentially expanding their relationship with you. And as a go-to-market firm, if that's a great signal for us. We can help you build top of the funnel, but if something's wrong with the product, we're not product specialists, so it's harder for us to help with that. So let's look at an example of this. You guys can maybe help me out here if you want to throw something in the chat. We've got two different companies here. One, I've labeled strong growth, and the other I've labeled as a red flag. Now you can see they both started with the same MRR, but I'm curious, if there's anything that you see that you would, in the red flag, that would be the difference. And this is also a great reason why, we shouldn't just look at beginning MRR and MRR growth, because people could continue to, in this situation, that both companies might be signing 20K a month, but what really we need to look at is what's behind that, right? So in the strong growth company, they obviously expanded, had twice as much expansion as the red flag company, and 25% or 75% less cancels. So overall, they ended above where they started, where in the red flag company, there's clearly something going on, right? Not as much expansion. And then they have more people canceling their product. And that's where they need to take a step back and say, okay, what's happening that we're not a fit, and let's fix that. One of the ways that you can help prevent that, which is something that we work on a lot with our portfolio companies, is by thinking about a leading indicator of retention. Because often companies, again, are focused on the top line, but you need to figure out, if you're not retaining and expanding customers, what's going on. And one way to do that is create this leading indicator of retention that helps you measure and predict if a company's going to stay and expand. Because again, a lot of you, especially if you're earlier stage, you can't wait a whole 12 months to see if this customer renews. And you also can't really depend on, well, we do a quarterly business review and they say everything's fine, because that's not quantitative, right? So this is what you want to do is look at something that is data driven. What is your customer doing, or what do you expect them to do that is going to show you that they're really engaged with the product over a certain period of time? So I've got HubSpot's here, which is that a customer is using 5 of 25 features in their product monthly, and they know if 70% of their customer base is doing that, then they're going to hit their number, because that 70% will expand. But they know that once they're using at least 5 features, that they're pretty locked in. So once you understand that about your customers, then you can revise your ICP to make sure you're also focusing on those customers, which is just as important, right, than just signing up anyone in order to grow your business. So here's an example. And if you guys want to throw it in the poll, you can, and we'll keep going because I know we've got some other stuff and I want to make sure to get to other questions. But these are 3 HubSpot customers. So based on their leading indicator retention, if you're looking at this, which customer is in danger of churning? And you can throw it in the chat if you want. But this is, a great example of when you've got a data point like that, then it's easy just every month to pull all the customers and then just highlight the ones, right? So in this situation, customer 2 is only using 3 features. They would certainly be on the 5 features or less watch list, and probably have some actions associated with that to make sure that they can move forward and move them into more features. All right. And last but not least, something that you'll hear folks talk a lot about is the lifetime value of a customer. And a lot of times you'll see this in relation to how much it costs to acquire them, right? So there's a ratio. What ideally investors want to see is that your LTV to CAC ratio is at least 3 to 1, which means that you're going to make 3 times what you spent to acquire that customer. It helps, obviously considering the customer's value and companies and put the company's number to predict the lifespan. And also will help you if you're doing it by different segments, right? So you might find that your enterprise customers are more valuable than your mid-market customers. But this is where, to calculate that, you're taking, the average recurring revenue per account, you're dividing times the gross margin, and then dividing it by the customers that churn. The reason it's important too as an investor is it helps indicate the total revenue that you can expect from a single account. So, it's easy then to do quick math, right? If we sign up X percent of these, they're worth overall this much to us. And it just helps predict what that business could look like in the next 2 to 3 years. So let me give you an example of this one. Again, I'm using another HubSpot example that they published in Forbes. But in this example, you can see that their average revenue in Q2 per account was $577. Their margin was 82%. So when you multiply those together, you get $473. And then we take out the operating cost and you divide that by your churn, and there's a lifetime value of $31,806. Once you divide that by CAC, your LTV to CAC payback is 4.7, which is a great return. And essentially what it's saying is, it's costing them a little under $7,000 to acquire a customer, but they're going to earn $31,000 on that customer. So that's a great investment. Now, as you're scaling, if you guys are doing this already, or you're investing a lot back in your business, you're hiring a lot of people and they're still ramping, you may see that your LTV to CAC is lower. As long as you know that's because of certain investments, but then it's going to even out, then it should be fine. And essentially what you want to get to is a place like this, where you've got, your customer acquisition costs basically staying the same, but you're continuing to drive more value with those customers, keep them on board, expand them, so your LTV to CAC continues to go up. So just to recap this, and then we're going to move into, okay, this is great, but again, how do I make a plan so that I can get there? When people are talking about unit economics, we're just talking about how much it costs to acquire a customer, retain and expand those customers, and what's the overall value of a customer to you. And so those are what you'll be focused on, or what you'll see in finance and in board presentations around CAC payback period, NRR, and LTV to CAC ratio. And as the revenue leader, it's really important that you understand how to drive those metrics, because that's your job. So it's not just something that comes up in the board meeting. So let's walk through that. And again, if you guys have questions, please feel free to throw them in the chat. So the challenge we often face as revenue leaders is that, we're getting a finance plan, right, that has all of these top line metrics, and then it boils down to, and if we're doing these, here's our CAC payback period, and here's our net revenue retention rate. But again, those are lagging indicators. We're usually measuring those at the end of the quarter, which means that we're getting an outcome after we've delivered results. So how do we make sure that we can deliver the outcome? And we're going to walk through how to do that. And I do have a model that, if you're interested, we can share with you as well. So when you guys took your current job, you probably handed something initially like this. There's a finance plan, right? And it has top line revenue numbers. And there's a total revenue number. Sometimes there's sales and expansion. And then it's got these unit economics that it boils down to. And I remember my first year at Living Social, we got the finance plan for the next quarter. And our finance plan, usually like a lot of top line finance plan, was all marketing driven, right? We were driving consumers to the site. We were a marketplace. So it was, well, we can buy enough people at this rate, and then we'll convert them. And, this is where we should end up in revenue. The challenge is that with that, and like a lot of finance plans, is there's no mapping to, okay, but we had to have salespeople sign those deals. We weren't self-serve. So do we have enough salespeople to sign those, or can we do that at a rate that makes sense? So when we went and ran this bottoms up model on a per rep basis to see, we found that we were close to $5 million off the finance plan. And that's a scary place to be as a CRO when you're delivering that plan. Which is why it's so crucial to do these bottoms up. So the reason a top-down model a lot of times does not work for us in go-to-market is because of what I just said, right? And I don't know if any of you have seen this, and if you have, you can throw a thumbs up or something in, but a lot of times finance plans are, we're assuming growth so either they're an increase in headcount without, and a lot of times it doesn't take into ramp and attrition. There's assumptions based on conversion that aren't using our actual data, but what we actually just want it to be. Or we're just putting in improvements that actually haven't been tested. So, if we right now, our close rate is 20%, but we're like, well, let's just put 25% in because I think we can get people there. Then already we're starting behind the 8 ball. But again, a lot of times this does not line up to the reps you have and the pipeline that they need to make this happen. And so let's talk about how you can go back and get a plan in place and build these leading indicators of unit economics. And that's by building what we call our bottoms up plan. In the most simplistic version, it's basically the number of deals your rep can sell a month, which is their productivity. What's the cost? What's their average deal size that they're selling? And then how many people are selling? And we strongly recommend not to throw reps at the situation until you can get the first 2 drivers right. So if you can get your unit economics right by getting your reps productive, then you can add new reps because you know that your leading indicators are right. So let's look at how that breaks down, right? With this approach, you break down the KPIs of each to look back at the pipeline in order for your rep to hit their number of deals closed. You want to also align with marketing on who's going to be driving that top of the pipeline. So what I recommend you do first is use your actual numbers, right? Go pull what your actual conversion numbers are, how many deals your reps are signing right now, what your current headcount is, what your current churn is, what your current ramping is, so that you can first build a baseline model that's realistic. And you've got a starting point there. And what that will look like when you build that is it'll spit out these leading indicators of unit economics, which basically means that per rep, how many deals can your rep sign? In order to do that, how many qualified opportunities do they need to have a month? And in order to get those qualified opportunities, how many leads, whether it's, if you're inbound, it's MQLs, if you're outbound, it might be accounts they need to touch, or your SDR needs to touch, but how many do need to be touched in order to get those opportunities? What's the average deal size? And then what's the cost to get that customer? If you have this, then you know what you need to be focused on each month. And it's all about what you're putting in. The most important thing is what you're putting in the top of the funnel to know that you have a pipeline. And so the reason we call this leading indicators of unit economics is because it can obviously take you a few months to understand what's happening in your pipeline. But if you've reverse engineered the model and you're putting in what you know needs to happen, then you should have it in your pipeline. The second thing it keeps you from doing is getting fool's gold in your pipeline. So often, we see revenue leaders that are now, I think about like last month in March, right? You're sitting in March looking at what's already in your pipeline and trying to figure out how you're going to hit your goal. And you might have had a couple reps that if you're only managing it by revenue, put a couple of big deals, then they're hoping those whales are going to close. They didn't keep adding their ongoing opportunities and deals they need. And now all of a sudden the deal doesn't close and you're stuck. But if you're balancing it by also focusing on the number that you need, not just the revenue, then you'll make sure that you have a healthy pipeline. And this is where you can now see what's realistic and also if it aligns to your model inputs. And then in typical, what I've done is taken this back then to my CFO and my CEO and marketing, and we've sat down and said, okay, what do we have here? What do we need to do? What's realistic? Do we need to bring down the overall forecast, or are there things that we should be testing so that we know in the next quarter we would be able to roll them out? So it just helps you really align, as well as making sure that what you expect your salesperson to do is realistic too, right? I've run these, and because of conversion rates, it showed that a salesperson had to do 50 demos in a month, and that's just not realistic. So obviously there's something else that needs to be fixed. Okay, and again, if you guys have any questions, throw those in. But now that we have a model that's driven by actual rep headcount and we know the pipeline we need, we can see, what our reps need to do on a monthly and even weekly basis, and how we're going to partner with marketing to do that, which is part of this model. There is a pipeline. Let's talk about how you can now manage that, right? How do you operationalize managing that pipeline? And that's where we recommend designing your dashboards so that you really can track performance back to this model. So what you don't want to do, and what we see a lot, is results being overwhelming for folks. I see dashboards where people, it just becomes this hodgepodge of things, right? You start by, well, we're going to track this, and then before you know it, it's like this scrolling dashboard, and nobody can focus on that. Your reps don't know what to focus on. You don't know what to focus on. The second thing that I see that folks do is you're just tracking activity and results on your dashboard, but not actually against a goal. So they just become kind of reports of activity versus a snapshot of how you're progressing. And then the third thing is actually the record of truth, right? The best way to actually drive performance against goals is having fewer dashboards, but make that the place to track company performance. Use them in your sales meetings, use them in your exec meetings, email them out. If you're doing that, then your team's integrity around actually putting things in your CRM and using it themselves will really improve. So let's go through the four. Well, and also if you guys want to throw in the chat too, if there's anything that you're using right now, we see a variety of things, right? Some people are using their CRM, but a lot of people are using Excel, some analytic tools like Insight Squared or Cluster, or pulling it into custom reporting tools like Looker or Tableau. So I'm curious, because I think there's not really one right way to do it. Folks have several different ways that they're doing it. So if you guys want to share anything that's working for you, throw it in. What I found, and I read a blog about this that we'll share with you guys, is that in order to keep myself sane and my team sane and make sure that we really were focused on both the leading indicators and what's driving them, that I could boil my dashboards down to 4 key dashboards: company performance, team performance, my leading indicators, because that's important, and then my wall of shame. So let's walk through these and when we would use them. My company performance dashboard is the dashboard that I would use to track overall results to plan, right? So you guys we're in Q2, you've got a quarterly plan, I'm sure, of revenue that you're supposed to hit this quarter or this month. How we're pacing, do we have enough in the pipeline? Are we retaining our customers? And then I also wanted to track, right, are we putting enough in the pipeline? So from those leading indicators, are we adding enough new ops and pipeline that we said we needed so that we're not screwed in Q3? And then I would use this in the executive team meeting. So when I showed up, instead of having, trying to download this all to Excel and match a bunch of stuff, I wanted it all in one place so we could see it in real time. And my team knew that too. My teams did. So that way they had to keep everything up to date. But a couple tips here is make sure to put the goal, not just the results. So that way you can see how you're doing. And I love, even Salesforce and HubSpot have a simplistic way you can show as you're getting better, and moving towards green. And then again, use this in every exec leadership meeting or my sales team leadership meeting. Get out a spreadsheet so that people actually, use this as a record of truth, and then keep it simple. So this one to me is we're not doing analysis. We're not trying to break down our customer segmentation. We're really just looking at, are we hitting our goals? We had a goal for revenue. We had a goal for what forecast we needed to have. We had a goal for new op pipeline. And then we had a churn goal, and how are we doing against those? In addition, I would also include, and I'm going to show you guys a couple of examples where you can see here, there's, the goal and then what's been closed won. I would also do my top rep ranking too on company performance, because typically people want to see that. And I would encourage other execs to Slack them and tell them great job. And then I'd have the weighted forecast, a lot of times broken out by channel, not by rep. So we could see how that was, that we were on track to hit that. And last but not least, we also had the new pipeline. So just as important to make sure that we knew how much new opportunities we need to be putting qualified in the pipeline so that we had those. And if there's anything else that you're tracking at a company level that you found is crucial for your business, I would love to hear about that. So now we're on to our team performance dashboard. And this is the dashboard you're going to use to track each team's KPIs on performance and activity. So ideally, a lot of their performance or activity is their leading indicators. And I'm a big fan of ranking team members or using colors to quickly identify people that have hit that goal. And I typically focus this dashboard on a daily, weekly, and monthly view in order to zero in on the activities that matter to drive pipeline forward. You might not need daily as much unless you are a short sales cycle, but for sure weekly and monthly. And this, should track again to your bottoms up model. So, if in that last example we saw where they were signing 5 deals, but they needed 20 qualified opportunities a month, that's 5 a week. So I would have a weekly goal of 5 qualified opportunities per rep, and, they'd be ranked. And once they got to 5, they were green, so that they were just in line with the same goals. And then we would back in again to how many accounts or MQLs they would need. And then once you do this, your team is really focused on, it gets them focused on the things that they can control, right? They can control moving things forward in their pipeline. They can control getting conversations, qualifying them, and getting qualified opportunities. And if they're doing that and they're getting 5 of those a week, then unless they're just horrible at closing, and you'll be able to see that and work with them, that pipeline and your revenue should be there. So let me show you some examples of what that can look like. Here's a team performance example, and these are a little small, so I apologize. Sometimes things look better on a big screen. But again, this is the record of activity and performance. It's what I use in every meeting, but you can see that unlike the company dashboard, which is high level by a channel, this is people, right? So you're looking to see who all is hitting their number of deals, their number of opportunities. If you're tracking meetings to get those opportunities, which I'm a big fan of, how many meetings they have, so they know those opportunities are coming and how many have held. Third dashboard, this is my leading indicators of unit economics. So this is where I had my own dashboard, so I could see for the month how we were doing against hitting those leading indicators that I know then will get us the revenue, but also the unit economics that we want. So you can look at, and most of these you can create a dashboard, so you can see, how many deals closed per rep, ops per rep, what the average deal size is running. Conversion rates you typically might not be able to do, but what you really want to see is, are we hitting those leading indicators? And then a couple other things I like to look at that weren't necessarily in the model, but how many reps are hitting quota, and are we selling deals in our ICP? Because that's going to make a big difference in us getting qualified deals. So I'll give you a quick example of what that looks like. And you can see here, we've got how reps are tracking. This one had discovery meetings per rep, leads, new ops. So we were able to see month over month how we were doing on hitting those. And then the last dashboard that I used regularly was what I call the wall of shame. Now, some people call this, needs attention or needs help. Essentially what this is the dashboard that nobody wants to show up on. So it's all of the things that that your reps need to do to make sure that your data is clean. And so it can include anything from overdue opportunities. So if they're past a close date, let's clean it up. If they have activities that they've marked in, they didn't, then they need to clean those up. We used to, and some of these you can automate. It depends on what you want to do in your business. I know at Living Social, we would, if there wasn't any activity in 60 days, we auto closed those opportunities. And then that account became available for somebody else. So it depends on how you want to manage your business. I mean, you can obviously manage these manually, but it's also a good check for, in one-on-ones, our managers would make sure, okay, let's just do a double check and make sure you're not on the wall of shame so that your business is in order. So I'll show you some examples of things that you might have on that. This is from, if you have an inbound, you want to make sure you're contacting leads in a percentage of time. You obviously want to make sure that people are continuing their sequences if they're going outbound. So whatever your criteria is, just make sure that you've got a place to accurately measure it and that your reps can see it and it's transparent. So I will wrap up by doing a quick summary. A couple things to keep in mind with this, right? People can only focus on 2 to 3 things at once. So keep your dashboards focused on what's applicable to the audience and make sure that it ties to your leading indicators so that you know what your team is doing, they know what they need to be doing, and they can see if they're on track to do that. Again, I love to rank them. I love to put colors so they can see how they're doing and make sure that they're utilizing this. So with that, I think we've moved to the Q&A section of our webinar. That's a lot of information, I realize, and not pretty heavy information on unit economics and being able to identify them and identify how to hit them and then measure that. So if there are any questions, we can take those now. Okay, so it looks like I've got some. So let's see here. Do you include first year PS revenue or 1 times revenue? Oh, I see what you're saying. So in calculations for the deal size, it's typically ARR, so you would include first year revenue. What technology do I recommend to do the math? Well, initially where typically people are using Excel, right? So if you see a monthly, you're running the math in Excel because it's just hard. And also a lot of times churn data isn't necessarily in Salesforce or your CRM. So your finance person is actually pulling from a couple different places and matching. So what I find is that, finance typically runs the monthly. You can, like we just showed for your leading indicators, get a lot of it in dashboards. But then some of those calculations for NRR and are typically Excel, or people are pulling them into another tool like Looker. Aside from features within the product, do you have examples of other leading indicators of healthy customers? Yes. So great question, Beth. And I can share some of the ones that folks are using in our portfolio companies. The biggest thing about that leading indicator of retention is just, what do you think the user should be doing that shows they're engaged in the product? And by the way, your first one, it's going to change. So initially what we tell people is like, let's just take a stab. We can go look at initial data and see what people are doing and then come up with something, and then we'll measure it. And it's either going to show us and have a correlation to retention, or it's not. And then we'll go back to the dashboard. But so some people have done, like we have a company called DeepScribe, and they are they transcribe for doctors all their notes, so that doctors don't have to, at the end of the day, enter all their notes back into their EHS system. So, but what we see is that doctors have to use it, right? So they're looking to see if doctors log in on a weekly basis. Because if that doctor is, and that means they're looking at their notes, they're uploading their notes that have been auto-transcribed for them. So that's, they want to see that in one account, that X% of the doctors are using it weekly. So that's an example. Other folks have seen that, similar, that either there's just some kind of usage data there that they're measuring that shows that they're interacting with the platform. So hopefully that's helpful, Beth. And if you have any follow-up questions on that, throw those in. What % of reps should hit quota? Great question, David. So what we typically look at and have seen now is you want roughly 65 to 75%, maybe up to 80% of your reps hitting quota. If it's below that, then your quota is either too big or there's something else going on in your process that for some reason. And that's where, if you're using that leading indicator, the great thing is you can easily see it, right? If your reps are supposed to have 20 opportunities a month and they're only getting 15, but the number of leads and accounts is still the same, then there's something about either your ICP or qualification that's not working. If it's that, you're driving enough top of the funnel, but your reps aren't getting the opportunities, then again, or, you're driving enough, and your reps aren't getting opportunities out of them, then that's a challenge. If your reps aren't closing the opportunities, they're getting enough, that's a challenge. But I think you'll want to back into that. Less than 65%, and then typically you have folks worried. And then more than 80% or 80 or so, and then you have folks that are, that you probably need to raise the quota a little bit. All right, we've got, what is the average ramp up time before adding a new rep to your dashboard? So what I like to do, so what we're seeing average ramp times in general in SaaS, Trina, is 4 to 6 months. You're right. Like when I'm doing those, I'm looking at ramped reps. But in the model that we'll share with you, you can add ramp in. So like the first month that your rep starts, it could even be 0.1, then 0.3, then or 0.2, 0.3, 0.5, 0.7, and then 1, the full head count. And then it'll calculate how much it'll make sure that you're still getting opportunities for those reps, but it'll calculate them separately so that you're not calculating a full head count against what you're producing. Sean says, you mentioned lagging indicator earlier. I noticed that Salesforce seems to be your source of truth. It seems that Salesforce can be very rep bias information and possibly a lagging indicator itself. How do you find risk signals by rep or by deal? How do you create course corrections or mitigate risk in the rev work? Yeah, great question, Sean. So you're right. Salesforce can be biased, right? Because our reps have the ability to move things forward. The biggest, I think, balance for that is making sure that you have clear framework and guidelines around what's a qualified opportunity, and if you guys have MQLs, what's a qualified marketing lead, what's a qualified sales lead or opportunity, and that you can flag those in Salesforce so that you know that they're not creating opportunities that don't fit that. So for example, at Zenefits, we had like 5 different criteria, right, for it to become an opportunity. A meeting had to be scheduled with a certain role. We had to confirm that they were using a couple, that they weren't using they weren't at a P, some technologies, and that they were using a couple other things. We had to identify what they were using right now for payroll and for benefits. So there was a list of criteria. It was all in Salesforce, and they could not actually create that opportunity until it was there. So that was one check there. So that way I would know, like, if we were getting enough opportunities, you know, that there's no way then to game that system. If they need 4 qualified opportunities a week, or you know, then they had to be qualified in terms of how we said they were qualified. And so that way I could easily see if we were getting enough. And then as you move further down the pipeline, we really recommend gating your stages by buyer activities, not by sales activities, because again, that's where you get, you know, somebody gets off a demo and they're like, I'll send you a proposal. And now all of a sudden you've got this account that's in proposal stage, but the buyer might have said, great, send me the proposal, and was thinking, I'm never going to get on that call again. So doing things like not allowing people to put something into proposal unless the buyer has either accepted or joined a call to review the proposal will keep things in gated stages. So that's one way where you can make sure that your reps, that you've got the same consistency throughout that pipeline. And that way you're getting the right results when you're looking at those leading indicators. Tony, is HubSpot tracking the features the customer is using to know that they are not using enough, or is it being tracked by another database and importing into HubSpot? That is a great question, Tony. I do not know. A lot of times that is most companies that we work with, and because they are a little bit earlier stage, their product usage is actually in a different database. So they have to pull those reports either into a shared place or they're using Excel. Some of them have started, you know, mapping back to their CRM, but that's where you'll have to figure out, once you figure out what that leading indicator is, you know, how you're going to report on it monthly. But you can even just start with, like, you know, you run all your companies against that indicator, and then you just sort in Excel. It's not the best, but it's, you know, it's at least giving you something that's actionable. Let's see, I don't know. So that might be all of our questions. Unless, Angelica, do you have other questions? Okay, great. Thank you so much, everyone, for bringing your questions. And as I mentioned, we do have a bottoms-up model. So if you haven't done that to figure out your leading indicators, we can share that with you, as well as how to build your dashboards.